Joining us now is the co-founder of Roubini Global Economics, also an economics professor at New York University, Nouriel Roubini. Thank you for coming on today. And Nouriel, I have to ask you, because we did hear from Greece today, they got that first $18 billion from the rescue package. We're seeing the euro bounce back a little bit today. This, at first glance, looks like relief. Has the sovereign crisis been stopped from moving into a financial crisis?
No, the problem has been just contained, and money, of course, helps, but all of these countries will have to do many sacrifices. They have to reduce sharply their budget deficits by raising taxes and cutting spending. That's going to be politically hard. They have to restore competitiveness and economic growth by doing painful structural reforms. And while the $1 trillion kind of EU IMF support package might help, all this money is going to come with conditions, and the markets are going to remain volatile and nervous as they see whether governments are going to be credibly committed to do what's necessary.
Greece leadership has highlighted that they've cut their budget deficit by like 42% in the first 4 months. They are taking some of those austerity measures. Do you think that that will allow them to revisit the debt markets? I know you've raised concern that they won't be able to in 2010.
They're starting to do the painful adjustments, but their budget deficit is 13.6% of GDP, has to be reduced to 3%. Their stock of public debt is going to stabilize at 140% of GDP under the IMF program. Their output is expected to fall for the next 2 years, and you already have riots in the streets, people dying, and strikes. And I think that the amount of pain is going to only increase, and therefore markets and investors correctly are asking the question how much pain a country can take when you have to have fiscal austerity and the recession continues. It's going to become politically challenging to do all these reforms and adjustments.
Now, when you said that Greece is just the tip of the iceberg, what did you mean by that? Are you saying that we're going to tip into a double dip recession on a global basis?
What I mean by it is that the kind of sovereign debt problem and deficit that are faced by Greece today are faced by many other countries in the Eurozone, by the UK, by Japan, by the United States. All these countries have budget deficits close to 10% of GDP, and the IMF is expecting their public debt is going to close to double to a level on average of 100% of GDP. So all of them are facing this tip of an iceberg of a sovereign debt problem that, unless resolved, can lead to a fiscal crisis. The crisis started as a private sector debt and leverage. We put many of these private losses on the balance sheets of governments, and now there is this massive releveraging of the public sector that, unless it's addressed, is going to lead to either default by some countries, or those who can print money could lead to high and rising inflation.